Hey everybody, welcome back to Dividend Stockpile, where we talk all things dividend and income investing related. In today's video, we're going to be talking about all the different closed-end funds I have in my accounts. So let's get started. So closed-end funds are a great tool for income investors. They generally provide high, stable, monthly or quarterly income and capital appreciation over time. But for those who aren't aware, I want to spend a few minutes talking about closed-end funds themselves so you know what to look for. So the things we're going to be discussing today is what are closed-end funds, or CEFs, some things to look out for, some ways to trade closed-end funds, and then we'll get into all of my closed-end funds that I have in my accounts right now. All right, so first up, what are closed-end funds? As you can see here, a closed-end fund, also known as closed-end mutual fund, is just an investment vehicle that raises capital and issues a certain fixed number of shares at the beginning of the IPO. And then it takes that money and invests in its capital in different financial assets, like stocks, bonds, private investments, you name it. It depends on the charter of the closed-end fund, but they can pretty much invest in anything that they want. Some other things about closed-end funds, they have a fixed number of shares. What that means is that when it IPOs, they collect a certain amount of money, let's just say $100 million, and they issue a number of shares based on that amount. So after that point, there's no new money added to the fund, and it's just those fixed number of shares. Those shares are then traded on the stock exchanges, just like individual stocks or ETFs, but there's no additional money going back to the fund company. It differs from an ETF, whereas you add more money or buy more ETFs, they add new shares to the ETF. Well, closed-end funds don't do that, hence why they're called closed-end. Once it's established, there's no additional funds. Because of that unique feature, the closed-end funds can trade at a premium or a discount to what their value is of the underlying securities that they hold. And they can hold everything from individual stocks, they can hold bonds, they can hold treasury bills, they can hold private investments. It's really unlimited to what their prospectus tells them they can do. Another unique thing about closed-end funds is they have the ability to use leverage or debt to enhance returns. So some closed-end funds have, say, 30% leverage, meaning they borrow 30% of the assets to purchase more investments, and some don't use any leverage at all. And it is managed by professional investment teams that are looking at the investments, making decisions based on their own intuition and research, as well as market conditions. You don't get that necessarily in an ETF, where a lot of those are passively linked to an index. It just buys and sells whatever the index is doing. This one has active management to help, hopefully, provide better returns or a more stable ride as you go through. All right, so some things to look for in closed-end funds. As we mentioned before, discounts and premiums. So there might be a closed-end fund that sells for more than the underlying value of the stocks and investments they hold, or it could be selling at a discount. So let's take an example of maybe a technology-related closed-end fund. It owns things like Apple, Microsoft, Nvidia, and so on. There's times, because the closed-end fund trades on the market just like the stocks do, they could be worth more or less depending on investor sentiment. So if the underlying holdings of Apple, Microsoft, and whatever are worth $50 a share, the closed-end fund itself might only trade for $45 a share. So there's a discount to the underlying value. And vice versa, if the underlying holdings are worth $50 a share, but the closed-end fund is trading at 55, that's considered trading at a premium, meaning investors are willing to pay more for the closed-end fund than the underlying value of the stocks. So that might be because there's increased interest. There could be because something is happening with the closed-end fund company itself. It could be expectations of those stocks being worth more in the future, so they're willing to pay more for the active management today. There's lots of reasons why it could be trading at a discount or a premium. It also could vary based on the interest rates of the economy and things like that. So there's a lot that goes into those discounts and premiums. The other thing to look out for is leverage. Some closed-end funds use debt to enhance their returns, and some don't. So you always want to look to see what kind of leverage they're using and what's that's going to cost you as an investor, because those charges for the debt is passed on to the shareholders or the unit holders of the closed-end fund. Because it is actively managed, there's management fees on all closed-end funds. Some are relatively low, let's say 0.5%, but some could go up to the 2, 3, even 4% a year in annual fees. So just make sure you know what those fees are and make sure you're getting your money's worth from those fees. And the last thing you want to consider is diversification. A lot of closed-end funds specialize on a particular niche, say technology or utilities or real estate and so on. So you want to make sure that if you are investing in closed-end funds, you understand what their holdings are and what their mandate is and what kind of sectors they invest in. And it might be important to have a few different closed-end funds so you get the proper diversification. Okay, and so after you've decided if you want to be an investor in closed-end fund, there's really two ways you can trade it. The first one is to just buy and hold. So you buy a particular closed-end fund, you hold it, you collect the income either on a monthly or quarterly basis, and you may or may not sell it in the future when the price goes up or when you retire and whatnot. So it's really just a buy and hold traditional investing. The other way you can trade closed-end funds is through trading in and out of different closed-end funds based on the premiums or discounts you might be able to receive. So if you found a closed-end fund that's trading at a discount, let's just say negative 10% off the net asset value, you might pick that up and then wait for it to go to no premium and no discount. So it's at 0%, so it's equal to net asset value. If that's the case, then you gain that 10% price appreciation and you received any kind of income during that time, and then you sell that and then you go find the next investment that might be selling at a discount. So a lot of people do that over and over, and they trade out of different closed-end funds over time depending on the premiums or discounts. And we'll talk about that a little bit more when we look into the funds that I have personally. Okay, and so with that, let's move over to my computer and we'll talk about all the different closed-end funds I currently hold. Now, please, before I go into the details of all of these holdings, please know that this is not financial advice. I'm not a financial advisor. These are just the funds that I'm holding as of right now. Please be aware that I could buy or sell additional funds at any time, and please do your own research before you make any investment decision. All right, so with that, the first closed-end fund that I hold right now is BST, which is the BlackRock Science and Technology Trust Closed-end Fund. Currently is about $40 a share, so the net asset value is $40.54, and the market price is $38.18, which allows you to get a discount, as we were talking earlier, of negative 5.82%. So you're actually able to buy the closed-end fund for less than the net asset value of the underlying holdings. That could vary over time, and that might be typical for BlackRock's BST, but we'll have to see if that's a good discount or not. The current distribution rate as of today is 7.86%, so that's a very solid yield on a science and technology related closed-end fund. So let's look at more at what the closed-end fund does. So it says BST is a closed-end equity fund, commenced operations in 2014 with the investment objectives of providing income and total return through a combination of current income, current gains, and long-term capital appreciation. Says it will invest at least 80% of total assets in equity securities issued by U.S. and non-U.S. science and technology companies in any market capitalization range. So you're going to look for, generally speaking, high growth and technology stocks, or the potential to generate current income from advantageous dividend yields, as well as writing covered calls. So that's how they receive the income, and then you're looking at long-term capital appreciation. And so this one in particular has done extremely well over this lifetime. If you look as of the end of 2024, the one-year return for NAV was 24%, and market price was 18%. But if you look over the 5 and 10 year, you're looking at 10.24 average over the last 5 years and 15.99 over the last 10 years. So that's a very solid return, and you get the income while you wait. Right, looking at some of the key facts, it is a monthly payer. So for those who are looking for that monthly income, you can receive it through BST. And as we talked about before, it's about a 6% discount and holds, as of a couple months ago, 95 holdings. So it's pretty typical in the just under 100 different holding range. It does do options on single stocks, so it's not doing an option on an entire index. So the managers are able to pick what makes sense at the time and only write options on a portion of the holdings. And it's a little old, but at August of 2023, they were only about 33% overridden, meaning they only have options on about a third of the portfolio, which allows the remaining 2/3 to have unlimited capital appreciation ability. All right, so scrolling down a little bit farther on their website, it talks about the fees. Now, the fees on BST are a little on the higher side, but not too bad for a closed-end fund. The total fees is 1.09% annual on the account. So looking at the holdings is who you would really expect from a science and technology type of closed-end fund. You have NVIDIA, Microsoft, Apple, Broadcom, Meta, all the ones you would expect. But one cool thing is about closed-end funds, as I mentioned earlier, is they can actually purchase private companies. So you see there's a couple on here. So there's Project Debussy and Project Picasso. Those are not public companies. Those are actually private companies. So digging into that a little bit more, I found an article recently on this particular ones. So Project Debussy and Project Picasso refer to BlackRock's private holdings in a company called Databricks. a global data and AI company. They were actually in the news just the other day for doing a new round of funding. And Quantum, which aims to build the first commercially useful quantum computers. So in addition to having the publicly available companies that we all know, you also have the ability to have some exposure to private companies based on the managers of the closed-end funds objectives and what they find to be interesting. So looking a little bit further, semiconductors are the main part of the holdings, which makes sense because that's been in such a demand lately. Other software, tech hardware, all the things you would expect from a science and technology related closed-end fund. All right, so that's BST for everyone. Next up, I want to talk about my second investment. It's called the Columbia Seligman Premium Technology Growth Fund, ticker STK. So this one, again, is actively managed, and some of the things they're looking to do is target long-term capital appreciation and current income with a portfolio of technology stocks. And they also write options as a way to mitigate downside volatility and to generate income. And so what this is a very concentrated portfolio, and it's based on their conviction. They use a growth at a reasonable price model to find better and more reliable performance than you would see otherwise. And they have very experienced management team. It says here that the main person has been investing for over 30 years, making him the most tenured manager in the technology space. Okay, that's a lot about the fund, but what's really impressive is the total returns. As of the end of 2024, they had an annual return of 27.61%, which again is very great. They do pay quarterly and is currently only at a slight discount to net asset value. What's even better about this particular fund is the long-term performance that they've received. And so since the fund has started, they've had an average annual return of almost 15%. And over the last 10 years, they've had an annual return of a little over 17%. So that's a very aggressive and consistent approach that's done really well for holders of this particular closed-end fund over time. So looking at the portfolio of this one, again, is what you would expect from a technology growth fund, Broadcom, NVIDIA, Microsoft, Apple, and so on. Everything you would expect. It is very concentrated. So at the end of December, 45% of the holdings was in this top 10. So it's a very concentrated portfolio, as I had mentioned before. All right, so moving on to the next one is the Cohen Steers Total Return Realty Fund. So as the name implies, investment objective of the fund is to achieve a high total return through investment in real estate securities. So it provides a high income and strong historical returns, and the ticker is RFI. So let's scroll down and get some information. So this one has a monthly fixed distribution of 8 cents per share, which gives them a distribution rate of right around 8%. And it holds 181 different companies, charges 0.89%, so a little bit lower than the previous ones, and it's been around since 1993. So the data here on the top holdings is a little old, but as you can see at that time, it had all the who's who's of real estate companies, so American Tower, Welltower, Prologis, Digital Realty, Simon Property Group, all the ones you would expect from a real estate related investment. So scrolling over to another website, this is the CEF Connect. It gives you a little bit more updated information, and this is as of 12/31. As you see, the top names have changed a little bit. We have Welltower, American Tower, Digital Realty, Prologis, Simon Property Group, Equinix, and so on. All right, so that is RFI. So if you're into real estate investment trusts, but you want it to be actively managed and you want to have a higher distribution rate, then you can get on maybe VNQ or one of those types of ETFs. RFI, the Cohen Steers Total Return Realty Fund, might be a good investment for you. Moving on to the next one, we have again Cohen Steers, but this time it's an infrastructure fund. So the ticker on this one is UTF. So what they do is they invest in securities owned by infrastructure companies. So it currently has a distribution of 15.5 cents per share. They do pay on a monthly basis. The distribution rate as of now is around 7.5%. They have 252 holdings, and they do use leverage on their closed-end fund at about 29.18% of the fund. So about 29% of the assets they borrowed to have additional money to invest. And because of that, as you see, the expense ratio is much higher. The way that works is you get the normal management fee from the closed-end fund, but then you also, as an investor, have to pay the interest that they charge for that leverage. So your total expense ratio is 2.77 if you include the leverage. Now, leverage can be a good thing because it can expedite or expand the returns they're able to provide, but in a downturn, it could also work against you because you end up owing money on stocks that are going down in value. So this one's been around since 2004. And as you see, ETF has top holdings of all the names you would normally expect from infrastructure. So you have American Tower, Next Era Energy, which is electric, Southern Company, Duke, so on and so on, PPL, Crown Castle. You get a wide variety of different infrastructure-related investments with this particular holding. So let's move over to the performance. As you can see, as of 2024, they had a very strong year, 22.33% return for the market price, which is a very good return. It actually was really close to the S&P total return. But if you look at the 5-year and 10-year, it has done a little bit worse than the market. 5-year is at 6.15% and 10 years averaging 8.95%, both of which are lower than the S&P 500. But again, that's not necessarily the reason for investing in this company or this closed-end fund, because you are looking for the current income and the sector focus on the infrastructure space. Okay, looking at their portfolio, you can see the breakdown of the different types of assets they had. This is a couple months old, but you have a variety of electric, midstream, gas, towers, airports, freight rails, toll roads, you name it. So anything infrastructure related, they can invest in ports, all kinds of different things, satellites. It's amazing what they can invest in. Again, that may not be something that you can invest in on your own, but because you're doing it through a closed-end fund, there's options there. All right, so looking at the distributions, they paid 15.5 cents a month for a long time. So it's a very stable income that you get from the Cohen Steers Infrastructure Fund, ticker UTF. UTF is currently trading at a slight premium to NAV at 0.61, so just barely over net asset value. And historically, it trades a little bit over as a premium as well. So it seems to be right in line with historical pricing of the closed-end fund compared to the net asset value. Looking at total performance, as you can see here, the year-to-date for 2024 was pretty solid, it's 22%. But in 2023, it lost money. 2022, it lost money. 2021, it was up pretty significantly. So it has a varied past. So this may not be the total return investment that you're looking for, but then again, the tides might be changing on infrastructure given the new administration's focus on it. So there might be some positive things coming UTF's way. And so that might be a good way to diversify your portfolio out from the typical ones that you would see in the S&P 500 or, the NASDAQ. All right, and last up for the different closed-end funds that I hold, this one is UTG, the Reaves Utility Income Fund. So as the name implies, it primarily invests in companies in the utility industry, but up to 20% of the portfolio might be invested in other industries. It started in 2004, and it has a fixed monthly distribution rate of 19 cents per share, which gives a distribution of approximately 6.7% right now. The net asset value and market price are very similar. You get a slight discount on the net asset value, but it's pretty much right in line with what would be expected based on the underlying holdings. So looking at the total return for 2024, you're looking at a 28% return. 5-year and 10-year is a little bit lower. Again, utilities haven't always been in favor, but over the last year with all the talk about data centers needing more electricity and things like that, utilities have done really well. 5 years at a little over 4% and 10 years at just shy of 7%. And since inception, back when it started, it's averaged about 10% a year. So pretty solid for utilities, nice and boring. So here are some of the holdings in this one as of right now. You have Talon, Vistra, which is going gangbusters this year, Constellation Energy, which is another one is at all-time highs. So you're able to take advantage of the increase in demand for utilities and ride that wave up when it comes to capital appreciation. And then also you're getting paid both on the dividends and through options writing every single month. So I like UTG. It's extremely stable, and because I've held it for so long, I've had good returns. So it's fit well in my conservative, stable portfolio. All right, so those are the 5 different closed-end funds that I hold right now. As I said at the beginning, I could decide to change those, so don't use this as long-term. You have to do your own research. But I wanted to show you the best 10-year performing closed-end funds. So the number one over the last 10 years is STK, which is the one we talked about, the Seligman Technology closed-end fund, and the second is BST, which is the BlackRock Science and Technology one. So those I both hold, but I don't hold any of these other ones in the top 15. But it's something to use as a resource when you're doing your investigations and your research into the closed-end funds you may like. All right, so hopefully you enjoyed that summary of my different closed-end fund holdings. In the comments below, let me know if there's any closed-end funds you like right now, or if you're interested in investing in closed-end funds. And if you are, while you're here, check out this next video where I talk all in depth about closed-end funds and all the details you need to know. Thanks for watching, and remember, keep stockpiling those dividends.